Professional Traders. Master's Courses in Professional Trading. Master 2019. Course 4. Price Level Lines, Ranges, and Pivot Points. Welcome to the course. Welcome to this Master of Professional Trading. This master is composed of 20 professional trading courses, aimed at new traders. My name is Amy. I am one of the Avatar's teachers of professional traders. And it's a huge pleasure for me to be here with all of you today. Today we are going to present to you the 4th course of the Professional Trading Master. Lines of Price Level, Ranges and Pivot Points. This course is aimed at those who want to enter the exciting world of trading. I will explain the concepts that you need to know about the price level lines, ranges and pivot points to become professional traders, and that you can live from this fantastic profession. From this course we will operate in the market. That is, we are going to do trading and we will do it consistently from the first day. And for this reason, let's start by studying the cycles of price movement in the market. After that, we will analyze the support and resistance levels of the price of any stock in a given time frame. Remember that the considerations that we establish in these courses are valid for any stock and any time frame. Presentation of the course. Becoming a consistent trader and investing correctly in the financial markets requires a great knowledge of these, effort and time. This translates into acquiring an appropriate technical training and a special psychological training, in order to successfully develop this profession. We know that many of you at this point will be excited and nervous to learn how to invest in the market, and others may believe that they will never reach consistency because they have tried it all. What I'm asking you is that the first thing that you should do is relax, study and follow our instructions. Every year 95% of the students of this master reach the consistency, and this year will not be different. In this course we will study how the price level lines are constructed, how the ranges are established, how they are limited with the border lines. And finally we will study how the pivot points are calculated and what they are used for. All this knowledge explained, we will apply in a real-time stock market graphics. In particular, we are going to start using the easiest stock market, which is the euro-dollar currency pair. The movement of the price in the market. The price of any asset or stock always moves between energy levels of the price. These levels are set by the support lines and resistance lines. And they are without a doubt the first clues that we must analyze. All market stocks have a fundamental characteristic, and that is that their price moves through cycles. But this does not mean that, for example, the price of the Dow Jones Index will necessarily be in the future at the levels that he reached in 1929. This is a mistake that many traders make. Think that a price of a stock must go back down to a certain level, very far in the time of the current moment. And they hold open positions sometimes up to a year, waiting for the market to regain access to the level at which they opened the position. It would not be academic not to explain the exoteric cycles in this course, so let's put some humor before fully entering into the development of this course. The exoteric cycles. This section tries to explain to what extent human psychology influences the market and how false principles can become inexorable truths. Go ahead that a consistent trader should never base a decision on superstitions or magic formulas, much as others create them. Obviously there are many phenomena both in nature and in physics that are difficult to explain and some impossible to explain with our current scientific knowledge. But that does not mean that any kind of explanation is valid if it is not based on proven scientific principles. Mathematics does not cheat. Our goal as consistent traders must be to follow the trend at all times. And for this reason, we will use our best allies, the high probability technical indicators based on mathematical formulas. Within this exoteric classification, it is true that certain cycles are fulfilled with a certain degree of precision, but their explanation is far from the foundations on which they are based. Most of them can be explained by the psychological behavior of the mass. Hence, the importance of psychology in the trading process. The cycles of Fibonacci. These cycles are the typical case that becomes important because as the mass believes fervently in them, it means that they usually work. Fibonacci invented a series of numbers in which the first two terms of the series are number 1, and the rest of the terms are obtained by adding the two previous terms. If we proceed to divide each term of the series by the previous term, the result tends to 1.618034, and that many other interested parties in justify this theory simplify again to 1.618. And if we calculate its inverse, the value obtained is 0.618034, that matches the previous value by subtracting 1. The conspiracy theory is born because in ancient Greece as in Egypt, this proportion was used as a dimensioning ratio in many of its constructions. And that is why many traders think that they can be applied to the financial markets. Through this ratio have been created the so-called Fibonacci retracements that we will study in later courses. It is essential to have them present on the trading screen because, whether or not we believe in this Fibonacci cycles, as the mass of traders is waiting for arrival at these key points, they tend to work very efficiently. The cycle of Euler. The Euler series is a geometric series in which the first number is 1, and the rest of the terms are obtained by multiplying the previous term by 3. The Euler series has a particularity and is that by adding or subtracting the terms of the series, we can calculate any integer number. Many traders ensure that the market moves through cycles that follow the first 4 terms of Euler series, 1 year, 3 years, 9 years and 27 years. The latter being the year of the end of the cycle coinciding with a financial crisis. Honestly, I have studied this cycle with historical market data, and I cannot see clearly that it is fulfilled. The only thing that is true is that, if we add the terms 3, 9 and 27, the result is 39. This number is similar to the number of Benna 38, that is obtained by adding the periods of Benna 20 and 18. On the other hand, that the market cycles have to coincide exactly with the Euler series is what does not fit me anymore. From my point of view, this is the typical case in which a guru creates a story based on a famous mathematician, and in the end does not lead anywhere, only to confuse the rest of traders. The Lunar Cycle of Christopher Carolan. Christopher Carolan developed a method of calculating cycles based on the lunar cycle. To do this, he used the ratio of Fibonacci series 1.618, and the following formula. This formula calculates a series of numbers multiplying the number of days of the moon year by the square root of the Fibonacci ratio and raising the result to n. N can take any integer value. Based on the dates obtained with its formula, Carolan establishes that it can calculate and determine what happens or will happen to a certain stock. Frankly, I do not believe it. I do not believe that the market is governed by the lunar cycles. And much less, that the Fibonacci ratio is a variable related to what a stock in the market is going to do. The cycle of Rosh Hashanah and Yom Kippur. The Hebrew calendar is a lunar calendar that works on the basis of the movement of the moon around the earth. The months of the year vary from 12 to 13. The even months are 29 days, and the odd months are 30 days. Therefore, the first day of each month would be the respective new moon day. The religious festival of Rosh Hashanah is celebrated in September, and the religious festival of Yom Kippur is celebrated at the beginning of October. In Wall Street it is often said that you must buy in Rosh Hashanah, and sell in Yom Kippur, and they are not exempt from reason. Both the crash of 1857 and the crash of 1929, as well as the crash of 1987, and the crash of 1997 on the Hong Kong Stock Exchange, occurred with mathematical accuracy on the 28th day of the 7th month of the Hebrew calendar. Coincidence or not, that the crises are related to the lunar calendar, as Carolan also predicts, is very difficult to assume since evidently, there have been other crises that have not occurred at these dates predicted. However, the mass of traders believes in the conspiracy theory, and waits for the next crash on the 28th day of the 7th month of the Hebrew calendar. The monthly cycle January to October. In general, the month of January is usually a month of buy trend, because the market of any stock tends to rise. And this is not due to any strange or non-market effects. This is mainly due to the fact that the investment funds and institutional investors restructure and endow their portfolios with new funds. On the contrary, the month of October is usually a month of sell trend. The nervousness to recover benefits in some cases, and in others to recover the investment or minimize the losses, causes sales to skyrocket. Another effect that occurs in October is that many companies usually publish an advance of results of the end of the year, that is usually more pessimistic than the real final results published, and this also causes an effect of poor results fear. The psychology of the mass of traders will normally adjust to this cycle. It goes without saying that, of course, there can be October months with a buy trend, and a month of January with a sell trend. However, I recommend that you always keep these two monthly cycles in mind when preparing your strategy in these months. The Benner Cycles. Samuel T. Benner was an American who tried to prosper in several businesses until he finished statistical, and ruined by the advent of the Civil War in the United States in 1873. In 1875, he wrote his market cycle theory. It was originally based on pork and iron markets, but its results are surprising. He established 3 guidelines. The first is the pattern called 8, 9, 10 years in which the market ceiling effect occurs. The second is the pattern called 16, 18 or 20 years of panic minima formation. The third is the pattern called 16, 18 or 20 years of bad times formation. In view of the results obtained by applying their cycles to the historical series of market data, the only thing that we can say is that Benner at least relied on real market studies of his time, and that his prediction is very close to the historical cycle from the market. What Benner could not have imagined is that these cycles are due to the psychology of the mass, and that is why they are repeated with a certain degree of precision. The Kondratiev Cycle. Nikolai Kondratiev was a Russian economist who defined the movement of the economy through the cycle that bears his name. Unfortunately, he died prematurely as he was condemned and interned in a Stalinist labor camp in Siberia. According to his theory, the economy moves in approximate cycles of 54 years. And each of those cycles in turn consists of 5 phases. First phase, Golden Age of Growth. In this phase, inflation grows slowly. Second phase, Prosperity. Inflation begins to grow faster than real estate debt. Third phase, Stagflation process. The economy has a high inflation with clear symptoms of cooling and slowdown. Fourth phase, Real estate bubble. Real estate prices skyrocket and rise rapidly thanks to the ease of obtaining bank financing. Fifth phase, Depression. The bursting of the real estate bubble takes place and a strong recession begins, that is, negative growth of the economy, more deflation. In summary, prices move strongly downward in all sectors of the economy. Again, the phases defined by Nikolai Kondratiev can be explained without doubt on the basis of human psychology. The only criticism we can make is that the cycle is too long to be able to determine its degree of accuracy, and that it does not establish the minimum and maximum market years. At least in this case, we can qualify that this cycle is quite consistent with the actual behavior of the market. The seasonal cycle. The seasonal cycle is widely used by traders who operate in the futures market of raw materials. It is what is called operative by calendar. That is to say, it is a question of determining in which dates of the year normally the futures on raw materials, and especially the agricultural products, tend to go down or to rise, due to the vital influence that in them they have factors like the types of harvests, the inclemency, seasonal weather, and the demand. The Moore Research Center Incorporated publishes a series of bulletins based on years of research on this subject. In their monthly bulletins, they determine for each month what the operative bi-calendar guidelines are, and provide precise information about the times of entry and exit through specific dates. The forecasts of operational bi-calendar published by this company have percentages of successes in the order of 85% as a mean value, and many of these forecasts reach 90%. Therefore, I recommend to those traders who wish to operate with great calmness, and without the pressure of the frenetic intraday activity, the study of these markets. The moral reward, the prize for study and mastery of this market is sensational. The cycle of the presidents. The cycle of the presidents could be defined as the one that shows that the market follows a pattern adjusted to the U.S. elections that are held every 4 years. The year of the elections is considered as year 4, and the year 1 is the year immediately after, and so on. As the election approaches, in the 3rd and 4th year of the cycle, the market tends to behave with bullish consolidated trends. However, as soon as the elections pass, the 1st and 2nd year of the cycle, the market tends to behave with bearish consolidated trends. The reason why it is produced is simple. It is the reflection of human psychology. As the elections approach, the candidate in power tries to convey that the market is the true reflection of its magnificent economic policy, in order that the electorate voted him again. However, after the elections the market goes down because people realize that whoever the president is, things do not improve substantially for the voters, which is why there is a certain discouragement. This effect has sometimes been reversed when voters have punished the president in order to pressure the change. The real market cycle. The movement of the price of a certain stock evolves according to fixed guidelines according to a market cycle. This market cycle consists of 4 phases. The duration of each market cycle is indeterminate and different for each stock. These market cycles are formed based on: first, international economic conditions; second, political constraints; and third, psychological constraints of the mass such as uncertainty, greed, and sometimes the panic of the traders. These market cycles are repetitive and consist of 4 phases. Phase 1. Accumulation, movement in more or horizontalized range. Phase 2. Bullish trend. Phase 3. Distribution, movement in more or less horizontalized range. Phase 4. Bearish trend. The attached graph shows the simplified market cycle corresponding to the movement of the price of any stock in time. In later courses, and particularly, when we study how the institutional intervention in the market influences, we will study these phases in full detail, and how we should act in the market consistently. Psychology and real market cycle. Our contribution to the market is insignificant to control the movement of the price of a stock, due to the size of our accounts. Our business is based on buying from our supplier or broker as cheap as possible and making small sales, obtaining a small profit in each of them. And the more sales we make, the greater will be our final benefit. Therefore, the style of scalping is undoubtedly our best ally. To understand the market cycle from a psychological point of view, we must consider and be very clear that the institutional investors or market makers, strong hands or lions, as defined by José Luis Carpatos, are those that move the market. Your investment decisions, BUY, and your divestment decisions, SELL, are what count. And the small investors, traders, or gazelles in their slang, we have no choice but to try to identify the clues that they are leaving to eat the crumbs they leave in their path. Always remember, the benefit of institutional investors is the loss of the rest of traders. Next, we will study the phases of the market cycle defined above. Accumulation phase. The institutional investor buys discreetly, ensuring that the price never rises from the percentage established in his investment plan. If the price tries to go up outside of the range, he allocates certain amounts of money so that the price returns to its position within the accumulation range. Each time the price moves down the range, the institutional investor re-enters with a large volume buy positions so that the price goes up and moves within the range. On the contrary, every time the price moves up the range, the institutional investor enters with a small volume sell positions so that the price goes down and moves within the range. When the accumulation process or buy process has ended, then the institutional investor dedicates a part of his money to create a false downward movement in order to the stop loss of the traders that have open positions in buy go off, so that they do not follow him. The final maneuver is to allocate the rest of his investment to generate an ascending wave or impulse in order to raise the price strongly through a powerful expansion. Bullish trend phase. After the first ascending wave, or impulse, reflected in the movement of the price through a powerful expansion, the rest of traders that have operations against the bullish trend generated by the institutional investor, they will open new sell operations that will create contractions in the price movement, and the institutional investor will generate a new upward wave that will be transformed into a new expansion. This sequence of expansion and contraction waves is normally limited to 5. Many traders have been caught by these movements of bullish expansion and bearish contraction. The majority will see in each bearish contraction a new change of trend from bullish to bearish, and they will not be aware of the reality until they have lost all their money. They will be hypnotized by looking at their negotiation screen, day after day, without being able to close their operations in losses, as they are convinced that not much longer, the miracle will occur. However, the miracle does not come before they have lost all their money. Distribution phase. When the institutional investor considers that he should not continue raising the price, because there are no longer so many traders that are willing to enter in buy operations at those levels, then the miracle occurs. To avoid the reaction of the market, what they do is to sell discreetly, ensuring that the price never falls below the percentage established in his investment plan. If the price tries to go down, they allocate certain amounts of money, so that the price will return to his position within the distribution range. The institutional investor creates in this phase an illusion similar to the one created in the accumulation phase. The media plays a very important role in this process, since this phase often coincides suspiciously with times when the media augurs great future increases in the market prices, and the euphoria reigns in the minds of all traders. Bearish trend phase. Once the institutional investor has sold all the stock, a fall arises by surprise, and the rest of traders, terrified to see that they made a mistake entering in their buy operations, suddenly, they will try to sell his operations hastily, increasing the rate of fall of the stock price. Consequently, a new trend is generated, this time bearish. The traders that were dismissed from the market for having kept excessive time their operations in sell, they will not give credit of what is happening, and all their consolation will be to say to themselves that they were right, that sooner or later the market will fall. Although determining whether it is an accumulation phase or a distribution phase is not an easy task, in the course on technical indicators, we will study in depth that by using the accumulation distribution indicator, we can determine with a high probability the phase in the one that we meet. The theory of Dow. Charles Dow in the early 20th century wrote in different articles a series of basic rules to understand the markets that today, 100 years later, are still fully in force, and are the subject of study by technical analysts. His theory can be summarized in 5 Dow rules. First rule of Dow. The price of a stock in the market has 3 trends. The primary or real. It is the real trend of the price movement. The secondary. It corresponds to the corrective movements against the real trend. The tertiary. It is the trend generated in the intraday. Second rule of Dow. Mathematics does not cheat. The medias discount absolutely everything. Third rule of Dow. All real trend is composed of 4 phases: accumulation, bullish trend, distribution, and bearish trend. Fourth rule of Dow. The moving averages must confirm each other. Fifth rule of Dow. A trend will be said to be in force as long as no counter signal appears. This set of rules from now on will be a reference for the establishment of our trading system. Levels, lines and dynamic lines. The most important price levels in a technical analysis are the horizontal levels determined by the support level lines, and the resistance level lines, since almost all of the pending orders established by the traders are based on them. The support level lines are lines that join two or more support points. A support point is a point that is formed when a change of trend from bearish to bullish appears. That is to say, the market at that point decides not to continue decreasing and the trend is reversed. Resistance level lines are lines that join two or more resistance points. A point of resistance is a point that is formed when there appears a change of trend from bullish to bearish. That is to say, the market at that point decides not to continue rising and the trend is reversed. Next, we will define and study the rest of the main lines that adjust to the movement of the price of a stock in the market. Channels, dynamic lines and trend lines. The price in the market always moves within a channel of three different forms: bullish movement, bearish movement, and lateral movement. The upper limit line of the channel is called the dynamic resistance line, and the lower limit line of the channel is called the dynamic support line. Both lines are the boundary lines of the price movement. When the movement of the price breaks the boundary lines of the channel, a change of trend takes place. The line of dynamic resistance is obtained by joining points of relative maxima. The dynamic support line is obtained by joining points of relative minimums. The bullish trend lines are the dynamic support lines. The bearish trend lines are the dynamic resistance lines. The crossing of two trend lines is an objective indication of a change of trend. The rule of the three touches. The rule of three touches states: if a resistance level is tested on more than 3 consecutive occasions, and subsequently a reverse occurs, then it is established that this is a resistance level of high importance. If a support level is tested on more than 3 consecutive occasions, and subsequently a rejection occurs, then it is established that this support level has a high importance. If a resistance level is tested on more than 3 consecutive occasions, and subsequently a break occurs, then it is established that this resistance level becomes a future support level of high importance. If a level of support is tested on more than 3 consecutive occasions, and subsequently a break occurs, then it is established that this level becomes a future level of resistance of high importance. Entries and exits of the market by levels. The entries and exits of the market must be regulated by a set of clear and concise rules that are part of our trading system. We are going to study below some of those rules that are related to the levels of support and resistance. And for this reason, we will use the attached graphic. We have represented the market entries in blue color and the exits in magenta color. First operation entry in E1 and exit in S1. We open a buy operation at level R1S2, once confirmed that it is a support level. We close the buy operation when the price reaches level R2S3, as it is a previous resistance level. Second operation entry in E2 and exit in S2. Although the price has risen above level R2S3, we expect the price to retest this level for the second time. At that time we open a buy operation at level R2S3, once confirmed that it is a level of support. When the price reaches the previous resistance level below level R3S4, we close the buy operation. Third operation entry in E3 and exit in S3. In this case, the price has risen above level R2S3, we hope that you will retest this level for the second time. At this time, we open a buy operation again at level R2S3, since the support level is confirmed. When the price reaches resistance level R3S4, we close the buy operation. Fourth operation entry in E4 and exit in S4. We observe that once the level R3S4 is crossed, the price enters a lateral range, and therefore we do not operate. Since level R3S4 has been tested more times than resistance level R4, a reverse movement is more likely to occur. For this reason we open a sell operation at level R3S4. When the price reaches the previous support level R2S3, we close the sell operation. Ranges analysis. The movement that follows the trend within the price channel is called expansion, and the movement against the trend within the channel is called contraction. The price ranges or channels can be established when the expansions and contractions in the movement of the price have similar lengths, determining relative minimums and maxima that can be joined by a straight line. The ranges should not be confused with the price levels. Two consecutive price levels form a horizontal range. However, the lines of support and resistance of a range do not have to be levels. There are two types of ranges, the horizontal ranges or static ranges, and the dynamic ranges. The latter in turn, can be classified according to the trend in descending ranges or bearish ranges and ascending ranges or bullish ranges. In the course book we develop this section in depth, and we explain you through different examples, how the ranges are determined, and how to operate in the market with them. You must study and learn the concepts that we explain in this section, due to its importance in the operation of consistent trading. Pivot points. Pivot points is a trading technique that is used by thousands of traders with success. In particular, it is widely used by North American traders, specialists in intraday, and in the trading style of scalping. Its formulation is very simple. To calculate them we need the following values. H is the maximum price of the previous day price. L is the minimum value of the price of the previous day. And C is the closing value of the price of the previous day. The way of operating with pivot points is frankly simple, and at the same time dangerous, because it requires a continuous monitoring. Basically this system consists of calculating based on the previous data, three resistance levels called R1, R2 and R3, and three support levels called S1, S2 and S3, together with the pivot level, by means of the formulation described in the screen. Let's start by analyzing the operative in levels S1, S2, S3. This system is based on the assumption that each time it reaches one of these levels, the price will rebound. Therefore, each time that the price reaches one of these levels, we will open a buy operation, since intermediate support levels are considered, and we will close immediately if it does not evolve properly. The operation in levels R1, R2, R3 is based on the assumption that each time it reaches one of these levels, the price will rebound. Therefore, each time you reach one of these levels, we will open a sell operation, since intermediate resistance levels are considered, and we will close immediately if it does not evolve properly. The pivot point P is used to determine the intraday trend. If the price is above this value, the signal that provides us is that the intraday trend is bullish, while if the price is below this value, the signal that provides us is that the trend of the intraday is bearish. The rules that you must follow for its use are explained in detail in the course book. Operative and the market. Well, as we promised, we will start operating in the market. At the moment, we will start by selecting the forex market, and in particular the euro-dollar currency pair. And for this we have opened a specific demo account for this master. This way all the operations we do during this master will be registered. The amount of opening of the simulation account has been $10,000. At the end of each course, we will publish the results obtained through our operational trading system in the course book. You must review the following sections in the course book. Trading style. Time frame. Determination of the real trend. Rules of entry and exit of the market. Monetary management and risk management. And study the operational example in the market that we have done. Conclusions. Achieving consistency in the market requires a process of technical training, and appropriate psychological training. You cannot do trading as crazy or based on feelings and opinions of third parties. In this course we have taught you one of the basic pillars that you need to master, since you will surely use it throughout your professional life. These concepts are the price level lines, ranges, and pivot points. Also in this course, we have shown you an example of the daily systematics of a consistent trader. In future courses we will expand this systematic, and we will teach you how to reach consistency. From today you must enter the market only in windows of high probability, that is to say in the moments in which the long trend and the short trend coincide. You must practice every day what we have explained in this course. Do not be afraid to confuse you. The important thing now is that you assimilate the concepts and practice until you reach the right experience. Golden Rules. Based on the concepts established in this course, we can determine the following golden rules. There are no magic formulas that inform us what a specific stock in the market is going to do tomorrow. Leave your emotions and feelings aside. You must evaluate what the price is doing without any external influence or prejudice. Do not enter in a stock operation without first having drawn the level lines and the range of movement of the price of the stock in which you are going to operate. Calculate, draw and analyze the pivot points of the stock price movement. We must always operate with the trend. Do not operate in lateral ranges, since a priori, it is not easy to identify if it is an accumulation phase, or we are facing a distribution phase. Do not operate if you are not completely sure that your entry into the market is perfectly justified. Entering a position in the market without the previous analysis exponentially increases the probability of failure in the market. Exercises of the course. Each course consists of 4 evaluation exercises. No question will be answered, nor will there be any evaluation, if the student is not correctly enrolled in the master, and if he has not paid the examination fees. Course exercises. Exercise 1. Carry out at least 10 operations in the euro to US dollar currency pair, following the method of analysis described in the course, and document them. Exercise 2. Carry out at least 10 operations in the euro to Japanese yen currency pair, following the method of analysis described in the course, and document them. Exercise 3. Carry out at least 10 operations in the US dollar to Japanese yen currency pair, following the method of analysis described in the course, and document them. Exercise 4. Carry out at least 10 operations in the US dollar to Canadian dollar currency pair, following the method of analysis described in the course, and document them. Farewell. So far the 4th course of the Master. Price level lines, ranges and pivot points. This course is part of the Professional Trading Master courses, aimed at new traders, developed especially for you. I hope that the information that we have transmitted to you is of your interest. Do not hesitate to inform you about the rest of the courses on our website. I wait for you in the next video of this exciting master. Until then, we wish you a happy trading.